In this chapter, we're going to go over how to value a company. So it isn't only important to pick the right stocks, it's important to buy the right stocks at the right times. And how do we determine that? Well, we determine that based on the value of a company. How do we determine the value of a company? Well, we're going to go over that in this chapter. So there are really three main financial metrics that we're going to cover in today's chapter. We're going to have a deeper dive into how you value a company later in this video. Later in this course. But in this chapter, I'm going to just cover the basics on how you should be simply valuing a company. We'll go over the most widely followed metrics. So really three main metrics: price to earnings, price to book, and price to sales. So let's start off with price to earnings. So this tells you how much a company is worth relative to its earnings. And to give an example here, so let's say you have a stock that's trading at $10 per share, and it earns $10 per share. Well, it would have a PE of 1. So this basically tells you that for every $1 of earnings, investors are willing to pay $1. And let's say we had a price per share of $20 and earnings per share was 10. Well, that basically tells you that for every dollar of earnings, investors are willing to pay $2. And then let's take a look at our last example here. So let's say we have a price per share of $100 and earnings per share of $10. That tells you that we have a PE of 10, which simply means that for every dollar of earnings, investors are willing to put $10 of capital up. And then let's just take a look at the formula so that we can kind of understand how this works. So price to earnings formula is just price divided by earnings. So we can see here that if we have a price of $10 and $1 of earnings, we have a PE of 10, meaning that every $1 of earnings the company has, investors are willing to pay 10. And then if we have a PE of 5, that means we have a price of 5 and $1 per share of earnings. In this example, so that would be a PE of 5. And once again, that tells you that for every dollar of earnings, investors are willing to pay $5. Simply, the higher this number is, the more expensive a stock is. The cheaper this number is, the lower this number is, the cheaper a stock is. And you can always put these numbers relative to the general market, right? So or the sector. So you can always go to the S&P 500 and see, all right, the S&P 500 trades at a 25 times PE. That's the current number. Let's say I'm looking at a stock that trades at 50 times PE. Well, I can know then that, okay, investors are willing to pay double the amount that they are paying for the general market in this stock. That means that this stock is expensive relative to the general market. Also, you can look at your general sector. So let's say I'm invested in a healthcare stock and it has a 10 times PE. And then I look at the sector average PE and it's 15 times. Well, that would tell me that this company's PE is actually cheaper than the sector, right? So that's kind of how you can use that metric. And then price to book ratio compares a firm's market cap to its book value. That price to book value formula is just price divided by book value. And then book value is, just for those that don't know, book value is tangible assets minus liabilities. So it's really just kind of the assets the company has on its balance sheet after its liabilities are accounted for. So common contributors to book value are equipment, property, inventory, and cash. And then I'll give you another example like I did with PE. So a $10 price per share and a $10 book value for a company would say that the price to book value is 1 times. And then $20 per share and a book value of 10 would say we have a 2 price to book. And then $100 per share, $100 per share, and then $100 per share and $10 in book value tells you that we have a 10 times price to book. And then, you can kind of see how that formula plays out. And then same thing with price to earnings. The higher this number is, the more expensive a stock is. And the lower this number is, the cheaper a stock is relative to its assets. And just like you can with PE, you can look at the S&P 500, say what the price to book value is, and compare that to the company you're looking at. You can also look at the general sector's book value, right, or price to book value, and look and see if this company is trading at a discount relative to its general sector. And then the third one here is price to sales. So price to sales ratio shows how much investors are willing to pay per dollar of sales for a stock. That formula is very similar to the others. It's just price divided by sales. Once again, here, the higher the number is, the more expensive, the lower, the cheaper it is. So that formula, like I said, share price divided by sales per share. And then just giving another example, I know this kind of is a little tedious and a little, repetitive, but I want you it just needs to be in your brain so we can kind of lay the foundation for the rest of this course. So price per share, $10. Sales per share is $10. That equals a price to sales of 1. And then $20 per share, and then sales per share of $10 equals a price to sales of 2. And then price per share of 100, and then sales per share of 10 equals a price to sales ratio of 10. And we can see that kind of broken down there. And then, like I said, the higher the number is, the more expensive a stock is. The lower the number is, the cheaper it is. And how do we use these ratios? Like I said, you can compare these to the general sector. You can compare them to the close peers, and you can also compare them to the company's own historical average. So I'm giving an example here for Apple. So Apple's trading at a 32 times PE, which is more expensive than the general sector, right? We see the sector median there at 18 times. And then the Apple's 5-year average is also 25 times. So this here, you can interpret a lot of things from this, right? We can say here that the PE is actually more expensive than the general sector, and we're actually more expensive than Apple's 5-year average. So that tells you that this company is somewhat overvalued. And then when do you use these ratios, right? So you would use these three ratios on different companies. So, really, PE, though, is universal. You can really use PE on every single company. It's by far the most widely watched financial metric as well. You always hear, investors talking about, PE is really like one of the first things that they always talk about. And then for price to book ratio, it's really used in companies that are really asset heavy, so capital intensive businesses such as financials, energy, and utilities. Those are really the three sectors that price to book is really talked about in. And then price to sales always is talked about in unprofitable companies, largely tech names, because they don't have any earnings to compare, right? They don't have any book value to compare either. So what are you left with? Well, you're just left with sales. So that's kind of why you're always comparing price relative to sales in unprofitable companies. So I hope that all made sense for you. Definitely check out the quiz and go back to this chapter if you get anything wrong.